What's the single biggest moment in a company's life? A lot of people would argue it's this, the moment it goes public. So today we're going to follow that journey, from a private dream to a publicly traded stock. Let's get into it.
Right? We see those ticker symbols scrolling across the news. We hear about these massive IPOs making headlines. But what does it actually take to get there? How does a founder's personal vision turn into a stock that, well, anyone can buy? And let's be clear, this is so much more than just a financial transaction. It's a complete transformation. You go from a company owned by a handful of people to being owned by potentially thousands. And that, my friends, changes everything. So it all kicks off with one huge decision, the decision to take that leap into the public eye. This whole process is officially called a flotation, but you probably heard it called by its more famous name, an IPO.
Yep, an initial public offering, or IPO. The name pretty much says it all. It's the very first time a company offers its shares, its securities, to us, the general public. And once those shares are sold, they get listed on a stock exchange. That's what's called the secondary market, and it's where people like you and me can start buying and selling those shares from one another.
But you gotta ask, why even do it? Why would a founder give up pieces of their company? Well, like any massive decision, there's a serious list of pros and cons you have to weigh. You could call it the price of admission to the big leagues.
And this right here, this is the heart of the trade-off. On one hand, the advantages are huge. You get access to insane amounts of money. Your company's profile goes through the roof, and it's way easier to attract top talent with stock options. But the flip side is pretty intense. The original founders lose some of their control. The company directors are suddenly under way more pressure, and you have to tell the public everything, which, by the way, is incredibly expensive to keep up with.
And speaking of all that new responsibility, you can't just wake up one day and decide to go public. Oh no. You have to prove you're ready to play by a very, very strict set of rules. Rules that are there to protect investors and make sure the whole market stays fair.
So at the end of the day, the whole system is built on one thing: trust. The rules demand that your company is legit and high quality. You have to be totally transparent, no secrets. You have to treat every single shareholder, big or small, exactly the same. And the people in charge, the directors, they're no longer just working for themselves. They now have a legal duty to do what's best for everyone who owns a piece of that company.
Now, there's no way a founder could get through this maze of regulations and paperwork on their own. It's just too complicated. So they hire an essential guide to show them the way. And that guide is the advisor.
Think of the advisor as the quarterback for the whole IPO. Seriously, they manage the entire thing. They handle the official proposal. They figure out if the share sale needs to be guaranteed by an investment bank. They are the experts who make sure every single I is dotted and every T is crossed. Okay, so if the advisor is your guide, then who's the referee? Because every league needs a referee. Well, in this world, it's the Securities Commission, or the SC. They're the ones who enforce the rules and make the final call on who gets to play in the public market.
The SEC basically holds the keys to the kingdom. They have to give the final yes on the listing. And maybe even more important, they go through the company's prospectus with a fine-tooth comb. That's that giant document that tells potential investors everything they need to know, the good, the bad, and the ugly, before they put their money in.
All right, so once a company gets the green light, they have to decide where they want to be listed. And not all stock markets are created equal. You can think of it like sports. There are different leagues for companies of different sizes and at different stages of their life.
And this chart lays it out perfectly. The main market, that's the big leagues. It's for the huge, established players, companies that have been around and have a proven track record of making profits. The ACE market, on the other hand, is more like the development league. It's designed for younger companies with huge growth potential. They might not be profitable yet, but they've got a killer business plan and a solid team.
So, let's say it happens. The company has picked its market, hired its team, gotten the approvals. The IPO is a huge success. But here's the thing. The journey isn't over, not even close. In fact, it's just beginning. Welcome to life in the public spotlight.
And you really have to let this sink in. Going public isn't a destination. It's not the finish line. It is the starting gun for a race that never ever ends. From that day forward, the company is accountable to the public every single day.
And that accountability means living under a microscope. There are strict disclosure rules. Any piece of important news, good or bad, has to be made public immediately. If rumors are flying around, the company has to address them. If the stock price makes a weird move, they have to explain why. Secrecy is officially off the table.
But look, all this scrutiny isn't just a headache. It actually builds public trust. And that trust unlocks a whole new toolkit for raising more money to grow the business even faster. The IPO is really just round one.
For instance, you've got bonds. The easiest way to think about a bond is like the company taking out a massive loan, but instead of getting it from one bank, they get it from thousands of public investors all at once. And in return for that cash, the company promises to pay everyone back with interest.
Then you have something called debentures. These are kind of like bonds, but with an insurance policy built in. They're secured against the company's actual assets. You know, their buildings, their equipment. So if anything goes wrong, investors have a claim on that stuff, which makes it a much safer bet.
And finally, you get these really cool hybrid products. They're like the financial version of a convertible car. They start out as a loan to the company, but they give the investor the option to flip a switch and convert that loan into actual shares of the company down the road. It's the best of both worlds.
But after all this, after navigating all the rules, the scrutiny, the fancy financial tools, it all boils down to just one thing. A single, overriding principle that now dictates every single move the company makes.
And that is the responsibility to the public shareholders. This whole journey is about that one transformation. A private company, driven by one person's vision, becomes a public institution. An institution that has immense power, for sure, but also carries an equally immense responsibility to all of its new owners.
So what do you think? Is going public the ultimate prize for a founder? The sign that they've finally made it? Or is it more like a golden cage, trading away freedom and control for a mountain of cash and a fancy stock ticker? That's the fundamental question at the heart of every single IPO.